Yesterday, I think the market's got a bit of a rude awakening just in terms of the inflationary numbers and what that might mean for the Fed. How are you playing this out? I think you've kind of been more in line with expecting some of these things.
Good morning, Becky, and thank you for inviting me again. I think yesterday's inflation number was not at all a surprise. I've been telling you and Joe in recent weeks, we are going back to 350 on the 10-year Treasury yield, largely because inflation was going to stay high. And yesterday it happened. It is going to continue to be that way. The question, Becky, is what does the Fed do? On September 21st, with everybody expecting previously a 75 basis points, at 1% seemed to be outlandish. But now that 1% increase seems to be increasingly the case with a number of people, I want the Fed to increase by 1.25 percentage points on September 21st. That's the only way Powell can stay ahead of the market rather than be a follower as he has been so far. Here is the problem. If he had had the proper policies in 2021 fighting inflation, we wouldn't be in the situation today. To gain back credibility, he really has to crush the economy, increase the unemployment rate, and it is not something we want, but that's what he's leading up to, and that's essentially what he has to do, 1.25 percentage points to show that he's in charge. It doesn't just matter if he keeps quoting Paul Volcker all the time. That will not bring inflation down. He has to act like Paul Volcker.
Paul Volcker raised a lot more than 125 basis points. But, Sri, the market right now thinks that he's going to do 75. There's a small portion of the market that thinks maybe 100 basis points. We talked with Roger Ferguson earlier. He doesn't think 100 basis points is going to happen, doesn't think that's likely. Do you honestly think 125 basis points would be something the Fed would consider next week? And would that actually fix things? Or is that just sending a signal that they are going to take a very hard stance on all of this?
Great questions, Becky. 1.25%, which I'm advocating, will almost certainly not happen. It is something that I want to see happen, but it will not with Jerome Powell being the chairman of the Federal Reserve. But if he doesn't, we are going to have this kind of discussion ongoing for the next year to year and a half. Inflation goes down 1 month, then picks up and goes up again. And we will be talking about the Fed continuing to increase interest rates. Why? Remember, Powell said last time he wants to avoid the 1970s phenomenon with Arthur Burns being chairman of raising the interest rates, then going easy, and inflation went up and then stayed, and that prolonged the problem and made it difficult for Volcker. Today, he's precisely will be doing that if he doesn't increase by 1.25% this month.
Emily, I know you're very concerned about what you've seen in inflation, too. What do you do as an investor at this point?
Yeah, Becky, this certainly raises the odds that the Fed needs to be more aggressive. I agree with that. But it also raises the odds that there's going to be even more damage to the U.S. economy. So we are concerned that economic growth is continuing to decelerate and that these inflation fears are ultimately going to translate into growth fears. And I know it feels challenging for fixed income investors on days like yesterday where we do see rates backing up. But we're looking at 3 to 5% on high quality bonds as a pretty attractive entry point right now, as eventually we do see the U.S. economy heading into a recession. And guess what? In a recession, bond yields go down. So we think even though we will likely see some choppiness here in rates over the short term, eventually we do want to gravitate towards bonds. And within stocks, we want to be really selective here. We're really embracing higher quality sectors, more defensive sectors, areas that can benefit from this big shift in consumer behavior away from the things that we want, given higher commodity, food, energy prices, more towards the things that we need. So utilities, infrastructure. We want to own companies with great balance sheets, good return on equity, ability to maintain margins as we face this big war on margins over the next year or so. So really getting active here, both on the fixed income and on the equity side.
Shepard Smith here. Thanks for watching CNBC on YouTube.